All right, everybody. It is Friday, August the 9th at 5 p.m. here on the East Coast. Market has closed and it has been quite a week. I'm joined today by my colleague, Chad Smith, and we're just going to do a little bit of a recap because it has been a little bit of a crazy week out there. We came into this week, Chad, Monday morning, we wake up, the Japanese Nikkei had fallen 12% overnight, and there was real concern that that might have spread or whatever contagion could have been there could have created systemic problems for the markets across the globe. And Monday morning, people were scared.
Oh yeah, absolutely. And it was a continuation of what had begun really Thursday and Friday of last week. And it really started with this concept of the unwind of the yen carry trade, right? You had the combination of the Bank of Japan talking about how they needed to raise interest rates, data suggesting in the US that the Fed needed to lower interest rates. And all of a sudden, as you mentioned on Monday when you described this, many institutional investors and traders around the world were scurrying to unwind these massive yen carry trades. That combined with a number of other factors, seasonality, like you mentioned, and concerns around the election, anxiety that's brewing there, really just culminated in this panic that set in on Monday. And as you mentioned, the Nikkei was plummeting, really, I think one of the largest declines we've seen since 1987 on a one-day basis. And as a result, this fear gauge that everybody refers to, which is the volatility index, and it tracks volatility in the market, it spiked overnight. It was indicating going to extreme levels. And sure enough, right at the open, when the VIX begins to trade, it spiked to over 60, went as high as 65. And what that reflected was just complete pandemonium, complete fear, and really just a function of people being so fearful of what may ultimately pan out from this unwinding of yen carry trade and all these other factors that could become a more systemic issue. And so all of a sudden you were faced with everybody running for the exits at the same time and trying to sell at the same time. And what that index reflects is this complete fear that's set in. And what's interesting is that index rising to over 60, that's only happened twice prior in the last 20 years. Once was during the height of what was going on during the financial crisis in 08 when the credit markets shut down.
Yep.
And then also during COVID in the midst of March of 2020 when the credit markets were shutting down then. And in one day, really one morning, the VIX index spikes to over 65. But yet, lo and behold, as the day wore on, the VIX index reversed, came back down below 40, but even below 35. And ultimately, just to show why it's such a bad idea to make decisions based on fear and emotion, the VIX index spike of 65 coincided with the bottom of the market for that day, and even eventually now, as we look back, for the week.
That's right. And, it's kind of interesting here as we're looking at the VIX index that this move that we had this week is kind of similar to what they referred to as Volmageddon back in early 2018. And our friend Larry McDonald, the author of When Markets Speak, that he talks about a similar scenario in 2018 about how traders were short volatility, and there was a massive unwind of that caused substantial volatility in the markets, billions of dollars lost in the face of that. But as you mentioned, and I talked about it in the video that I recorded on Monday, that we don't believe that people need to make emotional decisions about their investments. And when they do, they're often wrong. And that our rules-based investment discipline, it really helps to regulate our emotions, helps us to mute the daily noise and really focus on the primary trends in the market. But this is why for us, we have a weekly time frame when we're looking at something. So I want to jump in, and I'm gonna look at some of the same charts with you that I was looking at with the folks on Monday.
Mhm.
So let's look at the S&P. We look at these weekly timeframes because, as you had mentioned, so here's the weekly bar for this week, and the low print that we had on this bar, we can
Mhm.
see where it opened right here, was based in the morning on Monday.
Right.
Right,
Right. Right when it opened.
this is when everybody was freaking out, when the VIX index was spiking to its high. Um, and even though Monday was a bad day, what the message that I conveyed when I came on was, uh, look, right now, even though it's a scary day and there's some scary news out there, we're still in an uptrend under our rules-based investment discipline as it relates to the S&P 500, and it
Mhm.
looks like we just are experiencing a pullback within that ongoing uptrend. And so let's not get overly concerned about what's happening on Monday. It's more important that we worry about where we
Mhm.
close on Friday. And lo and behold, the markets rallied throughout the week. We're still very much turned on, according to our rules based investment discipline. This is still an uptrend, nothing to be concerned about here. I will share one thing that unfortunately, too many people who are not using the rules based investment discipline, they were the victims of their own fear and concern
Mhm.
on Monday. Bloomberg publishes this article that says that the most amount of activity that has taken place inside of 401k accounts happened on Monday, right? This article was from Tuesday, August the 6th.
Mm.
And so a bunch of people panicking.
Well,
And
what's also interesting about that headline is you notice it says since March of 2020.
yeah,
So the inference is that, you know, that also was a time of high activity in the midst of a turmoil in the market in March of 2020,
that's
right?
right. So we saw that other example of the VIX being at those elevated levels when fear and uncertainty, when they're at their heights.
Yep.
uh, Probably not a great time to be a seller. Unfortunately, that's when people will make the wrong decision and sell. Not
Mhm.
that we think that they need to be in all the time, uh,
That's right.
but but when we get these spikes in volatility, particularly when they're happening in the midst of uptrends, it's something that we believe that people have got to bear. That's the risk that they bear as an investor. Um, as long as the overall trend is favorable for them. So let's go on and let's look at
Yep.
just a couple more examples here. Um, so the equal weight S&P 500 index, um, you know, it too through on Monday basically came down and challenged this uptrend line, but for the week was basically unchanged.
Mhm.
So all the noise happened on Monday. Again, this is why we have these weekly time frames to try to mute that noise. Because when you look at this and there's no headlines on the chart, there isn't anything on here that's overly concerning,
Sure.
right?
Yeah.
Small caps, kind of similar story. I think when I looked at this on the video on Monday, it too, had fallen a lot through the uptrend line, right? Had opened beneath that on Monday, but rallied back throughout the week, still in an uptrend here. So nothing to be overly concerned about right now. It's definitely off the highs of where
Yeah.
it went to in July.
Well,
But
what's interesting there, Stephen, is the rally that we saw that was more broad based in many asset classes in July, which we recently highlighted in our monthly video. That rally, like you see in small caps there in July, was significant. All that really happened was in a very short period of time, you basically gave up those gains, and now you're back to kind of really where you were in June, still in the
yeah,
uptrend, though, still in the uptrend.
yeah, still in an uptrend, but importantly, to your point, at a higher price today than you were at the end of June.
Hmm.
So the market's still been able to make some progress here um, over the last 6 weeks, even though we've had this pullback. I want to look at a couple of the international indexes here really quickly. Let's look at emerging markets, and then we're going to do bonds because these are the areas that were in tandem with what was happening overseas and in Japan. Were really freaking out on Monday. And this one, you can tell it opened on the absolute bottom of the week, right? So the left tail here of this bar is where we opened, and it is at the absolute bottom here of this bar. So opened at the absolute lows. So people on Monday morning who couldn't wait for the market to open to say, get me out, were selling at the absolute worst time. Our rules-based investment discipline would have said, well, we gotta see what happens here throughout the week.
Right.
We rally back and we stay within this uptrend. And importantly, and you and I talked about this throughout the week, and I know I cover it in the monthly review that we're putting out for people here today. We've gotten back above these highs from 2023, which are so important.
Yeah,
And
absolutely.
so we have seen buyers show up at that level. So I feel for the people who were selling down here, who
Yeah.
were acting on emotion, who didn't have an investment discipline to really temper that for them. I hate to see that. Let's end here looking at some bonds, and then we'll wrap up. So bonds, kind of an opposite story. Interestingly enough, they opened the week basically on a high,
Yep.
and then they sold off a little bit as the stock market regained a little bit of footing.
Absolutely. But yet still, as we've been talking for a while now, bonds are in this gradual uptrend from the fall.
Yep.
And that has just kind of continued on now for the last 6 weeks, really, in general.
No, they have, and they've taken out some material former levels of resistance, which I think is very constructive. The likelihood that the Fed is going to be lowering rates sooner rather than later. There was talk early this week that we were going to have some sort of emergency Fed action, an emergency rate cut. That's probably not going to happen.
Right.
But we are likely on a more accommodative policy path. We're likely to see interest rates headed down in the not too distant future, and that should be constructive for these high quality bonds. And a lot of people still don't own bonds, right? They bailed out of them a couple years ago, but they are, once again, they're providing some buffer to a diversified portfolio. So,
Yeah, absolutely.
anyhow, well, Chad, thanks for hopping on here today and have this conversation with everybody. I hope they find it helpful.
Yes, sir.
If anybody is interested in learning more about our rules-based investment discipline, please don't hesitate to reach out to us. Send us an email to info@reveillewealth.com. Have a great weekend, and we'll talk to you next time.